Hello everybody, Luke Gromen, FFTT. Hope you are well. Hope you're having a great week. A little bit of a midweek update here. Thank you first off for everybody submitting questions. Very helpful, always gets my brain going. Really enjoy these interactions. So with that, I'm going to jump right in. The first question from Gary. Please discuss the yen, how far it goes, 152 question mark. If and when the Ministry of Finance and Bank of Japan intervene, and how successful or unsuccessful the intervention will be. Will Japan have to raise rates before 2024? I don't know. I don't have a strong feeling on it in terms of a level. My view that I do have a strong feeling on is that as long as U.S. deficits are as big as they are, as long as the Fed is not monetizing them either directly or indirectly via the banking system or treasuries running down TGA or the different ways of dollar liquidity being injected to absorb those. And as long as oil prices are rising, my answer in terms of the yen is it's going lower. They'll sell treasuries and repatriate Japanese capital from abroad, heavily U.S. dollar assets in all likelihood. And that's going to keep the dollar up. That's going to keep rates up. That's going to keep this spiral that we're starting to see accelerate in the last week or two in terms of dollar up, rates up, risk off, accelerate. So for me, the key is that there's really no brakes on this train unless the dollar and oil are weakened markedly. I think that's the key. So realistically, in terms of mechanics, they can play defense. The Japan Bank of Japan Ministry of Finance, they can play defense tactically. They can jawbone. They can try to raise rates. I don't know that that'll help a whole lot. Other than tactically, they can sell down dollar assets. But ultimately, the size of U.S. deficits and the net issuance sizes, where it's not just deficit, but then also foreign selling of treasuries from around the world to defend their currencies. The only really sustainable way to weaken the dollar, in my view, is renewed QE or yield curve control or its equivalent here in the U.S. So, from John, do you feel gold will drop to 1800-ish before the rally near term? Yeah, it could. I wouldn't be surprised about that at all, actually. It depends on two factors, in my opinion. Number one, when does the Treasury market dysfunction get bad enough to bring Fed or Treasury back in to supply liquidity? And two, if Fed and Treasury don't step in fast enough and let Treasury or this Treasury rates up dollar feedback loop keep driving rates up, at what rate does the market begin to say the West is insolvent? At a sovereign level, at this rate, buy me gold. And it's tough to know what that rate is, but it ain't that far from here, in my opinion. So at that point, I suspect you would start to see gold really separate from real rates in a way that we've started to see since 2022, and particularly the late 2022. But I think it would really start from that point. So with that said, in between now and either one or two, could I see gold sell down to 1800? Absolutely. Am I selling it? No. I own physical, held out of the banking system at vaults at cities in the region, and I'm unlevered, and I'm playing for the end game. I only need to be right once in my life. So now, I would be doing something different if I was a levered player or if I had a monthly mandate. So take that based on your own personal positioning. From Edward, doesn't it make sense to sell treasuries as a foreign nation when they knew rates would rise? I asked this because you mentioned them dumping them, but this makes perfect sense. They'll rebuy the treasuries when the rate hiking cycle ends. In the meantime, they'll buy hard assets. Central banks don't trade to maximize profits. They already have a printing press. They literally can print money if they wanted to. So that's not, they don't act in markets to try to maximize profits like most private sector actors would. They trade to manage their domestic currencies and their domestic economies and for political reasons. So they're selling these treasuries to support the currencies and to buy oil. They're short oil, they're short dollars, they're selling treasuries to buy both. They'll keep selling. As long as the dollar rises, they have to keep selling. If they run out of dollar assets, treasuries to sell, then they have to devalue their currencies. And this is the part that actually is very different this time, that most market participants, in my view, and certainly many market participants, are not factoring into their analysis. It's why so many have been trying to catch the falling knife on TLT and getting their heads kicked in, which is, historically, that's how it worked. Foreigners sell down dollar assets, they run out, and then they have to devalue their currencies. Restart the game. Now, the U.S. net international investment position is negative 70%, 70% of U.S. GDP, which means foreigners own $18 trillion more in U.S. assets than we own of theirs. From 1976 to 2012, the U.S. net international investment position was positive 10% of U.S. GDP to negative 20% of U.S. GDP, which meant foreigners had a small piggy bank they could sell down, and then they would run out of dollar assets, and then they'd have to devalue. Now they've got a gigantic vault of dollar assets, and they will sell, and they'll keep selling, and they will send rates higher and higher, and the dollar higher and higher, and they will break treasury markets, they will break U.S. housing markets, they will break U.S. banks, they will break global banks, they will break the global economy, they'll break global system before they run out of dollar assets to sell. And it's critical that people understand this. There's no brakes on this. So the brakes are the Fed and the Treasury, weakening the dollar, resuming QE, whatever you want to call it. I still don't think this last part, this net international investment position size differential, is understood by enough people. Because if it was, people wouldn't be falling all over themselves to try to buy TLT. Like I saw a tweet today that TLT inflows are still massive. If nothing else, you would stand aside and see where its level is, because there is just, as long as the dollar and oil are rising, it's just going to be a lot more selling to come of U.S. dollar assets. It's just how it is. From GG, I'd love to hear more about the gold premiums in Shanghai versus COMEX and what it means. China weaponizing gold, ? And how you see this playing out. To oversimplify, it means gold buys more energy in China than it does in the West. This would not matter if oil and gas were not priced in yuan, if they were only priced in dollars still. However, they are priced in yuan. The Russians are selling in that. The Iranians, the Venezuelans. A good 25-30% of global net exports can be bought in yuan now. That changes everything. It sets up an organic arbitrage where it's a real stimulus. Cheaper energy drives faster growth, which drives more gold buying in China, which drives the ability to buy more cheap energy, which drives more growth. Wash, rinse, repeat. Everyone talks about China needs to do stimulus. Very few people seem to think of cheaper energy as stimulus. What if I gave New England, for this winter, half-price gas and heating oil? That would be a huge stimulus for the northeastern economy. People would go out and they'd have a lot more money to spend on Christmas gifts. China's effectively getting that. Not quite as dramatic in terms of the premium, and it's not going to be all right away, but particularly if Russia goes through with what they said they're going to do, which is sell gas to China at half price relative to Europe, beginning in January to last for 3 years through 2026, gold's going to buy a whole heck of a lot more gas in China than it does in the West. And as long as that happens, gold and gas and growth are all going to flow to China. And that's how it's going to work. And so that organic, most of the Western traders, they went, okay, how do I have the immediate trade? How do I have the immediate? And yeah, there's sort of an arb there, and some people are on the margin. The real thing here, it's an organic economic stimulus / arbitrage that will be like a slowly tightening noose. It'll just slowly drain gold from the West, and it'll slowly pull more energy toward China, which will slowly allow China to outcompete Europe and, to a lesser extent, the U.S., until the U.S. lets gold rise. That's what's being set up here in my view. So, CM, can you explain fiscal dominance in light of the Fed's balance sheet already at $8 to $9 trillion? Haven't we already been dependent on the Fed to cover deficits? If we survived $9 trillion, why not $20 trillion? And I think we will get to $20 trillion. That's on the come. However, fiscal dominance, to simplify or oversimplify, is that the Fed cannot raise rates without putting the U.S. government into a situation that requires the Fed to print money in order to prevent default on entitlements, defense, or interest, which are the big three things you can't cut. And we're there and we've been there. And so the debt and the entitlements are so big and the economy is so financialized that higher rates sends expenses up and deficits up rapidly and receipts down rapidly. So basically it just means the Fed's no longer in charge of inflation. The fiscal deficit is. The Fed's just making it worse by raising rates. So that is the issue. Now, critically, when the Fed is selling bonds on top of Treasury to do this, it leads to this dollar squeeze, which is going to drive dollar up, rates up until the system comes unhinged. And that's another way you can tell we're in fiscal dominance is the deficits are so big they're crowding everything else out. If that wasn't the case, we wouldn't be seeing what we're seeing in markets in terms of the dollar and rates, certainly to the extent we're seeing it. And then the final question from Sylvester. What's the question you think your audience should be asking but isn't? I would say, why does the net international... I did a tweet last week. I actually got a ton of interaction, ton of views, highlighting that I take any rate cycle analysis, looking at the last 6 or 7 rate hiking cycles, and unless they attach the caveat that none of those rate cycles have had the net international investment position of the U.S. this negative, they've never had the U.S. debt this high, they've never had U.S. Deficit to GDP this high, and the U.S. has never been the world's biggest marginal high-cost energy producer, oil producer. If they don't have those caveats, I basically ignore that analysis because it's going to be flying blind. Why is that the case? The net international investment position I just described, the debt to GDP, the deficit to GDP, it means you're going to get this pro-cyclical dynamic that has no brakes on it. Dollar up, Treasury yields up, foreign selling, interest rates up, deficit up, more issuance up, Treasury sells more, dollar goes up more, Fed sells more, foreigners sell more, and there's just no brakes on it. And then the other side of it is that as rates go up, U.S. oil production is ultimately price and interest rate sensitive and will drop off first and fastest. And ultimately, U.S. oil production on the shale side will, after an initial period where it falls less fast than demand, it will eventually fall faster than oil demand does, even in a recession. And that leads to a very stagflationary dynamic, which then leads to feeding back into what I just described. Rates up, dollar up, foreign selling, etc. So there's just this all those factors, when you combine them together, lead to a very pro-cyclical dynamic into an over-leveraged system where the biggest marginal buyer treasuries in recent months have been highly levered hedge funds. Joseph Wong on Twitter has done some really good work on that, former New York Fed trader. In recent weeks, I'd take a look at that. So that's the big difference. And so it's really important to understand that looking at the last 6, 7 rate hiking cycles in the United States for guidance is going to lead you to the wrong conclusion. You need to probably be looking at rate hiking cycles in Argentina and Brazil over in, call it, in the 80s and 90s, and kind of tamping down the extremity of the outcomes. But in terms of the directional implications, they're probably of more use. So with that, I'm going to sign off for tonight. Quick reminder that this week we do have upgrade cycle for our Tree Rings product. There are bonuses. You can learn more about it in the link below. In the meantime, also check us out, FFTT-LLC.com, for what we're up to and more information about these updates. If you like them, you can check out Tree Rings, 10 most interesting things, what's grabbing us about each thing, and whether it's confirming or denying a prior view we had held and what it might mean for various asset markets. So, as always, thank you very much for joining me. Really enjoyed it. Look forward to chatting with you soon. Have a great rest of the week, everybody. Take care.